Good morning, ladies and gentlemen. Well, very big news this week with Powell, and I'll go in detail about what he said and what the implications are. We'll just start off with a risk dial. We are at 45, which is actually the best score that we have seen since the beginning of the rally, and you can see all the scores in the daily model box below this chart. Don't forget that this score has absolutely nothing to do with price. It has to do with the spreads and the way they are positioned. So the fact that they are at their highest score together with price is confirmation. So up we go. There is absolutely no reason to expect any bout of risk off. In the weeklies also we are getting the best scores and indicates a continued uptrend in risk. And finally, in the monthlies, we're about to have also the highest score at the end of the month, indicating that the next month will be a continuation upwards. These moving averages have a lot of room on the monthlies to go up, indicating that this could well be an uptrend in risk which lasts the best part of a year or so. It's important that you download deviations and have a look at it every day. Here we are, we're just ascending slowly along the red line in deviations in SPY. All the sectors are basically within deviations, as the only one, the exception is XLK, obviously, which is too far ahead of itself. But there's room in all of them to do better, apart from XLK, which is really getting silly, and at some stage will dip below, and that will be the opportunity to get it. Something like a repeat of this area here. But there's room in every single one of the others to catch up. And actually the one that I wanted to actually show is XLP, because if multiple expansion is going to be surest in XLP and also in XLI and much less so in XLF, but that's a different story. But the one that I'm beginning to like is also IWM, which can catch up some. And finally, the one that I will talk about later is actually EEM, which I think now has the potential to strike significantly higher. I've been trying to look for someone who has basically written up the Powell speech and the new Fed rules in a way that I understand them and that I agree with. And this is the guy I've found. I find this completely logical and exactly what I'm thinking about. So try to read it yourself. This is the address that you have to point towards. But basically, what is he saying? He is saying that this means lower for longer. I absolutely agree with this, because what he is saying is that they will tolerate higher inflation if they think there is room for unemployment rate to come down and adjust to whatever the normal risk-free rate is, as it were. And I think that everybody can now agree that that is significantly below 4%. Now, whether it's 3.5 like it was or 3.1, who knows, but it doesn't really matter. Basically, the Fed has failed to reach the 2% inflation target, even when unemployment was at around 3.5%. Now, how on earth the market can possibly start tightening conditions until unemployment is way below 5%, I have absolutely no idea, and it's not going to happen. But the big question is, what is the Fed going to do? How can they get unemployment that low and also get inflation above 2% and tolerate it above 2% for a while. Well, the only tools they have are QE and very strong forward guidance. The forward guidance they've tried already. I mean, they've given us the forward guidance for a long, long time and nothing. So they only have QE. To me, this means that QE will go on for much longer than people think and will be much more aggressive. So, given that they only have QE, given that the US will not go below 0% nominal rates, all they have is basically a rule which says that rates are going to be much lower for much longer. Please read this article. I agree with it wholeheartedly, and I agreed with it basically since the day the policy came out on Thursday. Does it mean that we steepen? Yeah, I'm going to go into detail there on the chart. But what I do think is that basically it compresses the volatility in the bond market for a long, long time. I think we can now forget about any rate hikes until the end of this decade. I would be shocked if we see any rate hikes from the Fed before 2027, 2028. Exactly what this curve shows. If that is the case, we are going to have movements in the curve, but we are going to have relatively very small movements in the outrights. That compresses the curve, the volatility of the bond market even further, and that can only be good for multiple expansion. So please read this article. I agree with it wholeheartedly. And now I'll go into details about what it means for the curve. Okay, what I've done here is I've put two charts next to each other. So the first one is 5s, 10s, and this second one is 5s, 30s. Now, it was to me pretty obvious that the first reaction was going to be one of steepening the curve. If somebody says to you lower for longer, and we will start hiking when unemployment gets much, much, much better, that gives you basically a target. If you couple that with the fact that we have such a huge budget deficit to fund and the issuance is going to be so huge and continues, there's absolutely no reason to believe it's going to get any smaller anytime soon, simply because there's going to be yet another congressional coronavirus package worth God knows how many trillions in the end. You just know that the market is going to steepen the yield curve as a first reaction. Now, what is the Fed going to do about it? Because this actually, a steepening of the curve, is exactly what they now don't want. They want to persuade you that things are going to be lower for longer for a long, long time. And I mean years, not days, weeks, quarters, but years, probably even decades. So at some stage they're going to have to come in and really start hoovering up the long end. I see no alternative to that. To me, the 5s, 10s region now should be absolutely dead, completely dead. Now, 50 basis points is the level that I'm looking at right here, and I would be very surprised if you can stay below 50 basis points. I think the risk reward of buying it at 50 basis points or just slightly better, say here, 53, but we are talking very small differences. So between 50 and 53, I think the tendency is going to be back towards flattening of the 5s, 10s. But the real important one is here, 5s, 30s. It couldn't hold this box 105, 109. boom, straight through 120. Now I think the 140 region is going to be really, really important. At 140, I think the odds of a reversal upwards back towards 105 are huge. It just doesn't make sense unless we expect an acceleration of inflation, and we actually see it, for 530s to be that steep and continue to be that steep. Because if you think about it, the Fed is going to keep rates low for a very, very long time. And I really don't see why people would be unwilling to buy 30-year bonds at around a 140 point differential to fives, especially when European rates are, in those tenures are way negative, or even as in the 30s, in the low single digits. I really don't think that the curve can steepen much beyond 140. And that is very good news for equities, because equities are going to tolerate anything that goes towards here, but anything below there, I think they might have a little bit of a scare. Multiple expansion, I think, is going to continue as long as the curve is contained and keeps on doing something like this. I really don't see this being a problem. Beyond it, I can see some small accidents in risk. Right, well, this is a chart of the 10-year yield going back all the way back to 2009, and I wanted to show you the episodes which would either not have happened or would have been very much more contained had this new Fed rule been applied throughout this period. Now, the market started tightening conditions, expecting the Fed to tighten between 2012 and 2013, expecting that we would start the tightening cycle somewhere around 14-15. In fact, the tightening cycle was pushed out to here, 2017-2018. So, with these new rules, we would not have had this episode here in 2011, which scared the market, but and we would not have had the QE2, 3, 4s. We would not have had this episode here between 2012 and 2014, or it would have been very much contained, say by another half to 3/4 of a percentage point. The market would have been relatively stable throughout this period. We would not have had these peaks, and the market would have stayed around these levels and then slowly started rising, but it would not have got to over 3%. It would have probably topped out around the 2.5% area. As you can see, what it implies is much lower volatility to the upside. We are seeing probably only half of the moves that we're seeing on the upside, and they are being lengthened out in time. What I'm now seeing myself is that I don't think we will see rates above 140 in the 10-year throughout the 2020s. Okay, I mean, write that down and call me out on it. I really can't see rates going up above 139 in the 10 years for the next decade. Now, what does that imply for multiples? What does that imply for risk? Well, if you are taking out 50% of the moves higher, for very obvious reasons, because the Fed is going to tolerate a higher temporary level of inflation unless and until unemployment reaches what they consider the natural level. In that case, Fed funds are going to be low, and if Fed funds are going to be low, the curve can only go up that much, because people will always be looking to make the extra buck, and they will be buying the longer tenures in order to make the money. They will just fund it. They will just basically, if you can afford to, what the banks are going to do and the investment banks, they're just going to hold much larger portfolios of US Treasuries because it's free money. Especially if the Fed comes in and lowers the reserve requirements and things that they can do to technically make it more attractive to hold the longer end. And I have no doubt that that is what they will eventually do. Plus the fact that they have only one tool left. Unless they want rates to go negative, and I firmly believe that in the United States is almost impossible, because it will wreak havoc. All the money market funds would break the buck, and I don't think that's worth doing. They have one tool left, and that is massive QE. I think the biggest player in the bond market is going to become the Fed, and I'm sure that they are going to intervene at levels. So be prepared for decades of lower volatility in yields. Well, the compression in volatility in the bond market, which the Fed is going to accelerate with its new policy, cannot not have knock-on effects on the US dollar. Now, the US dollar is the differential between one policy and another policy. We have the US policy, but we don't have the response from the European side. Is Lagarde going to do something similar, is the question. I don't think so. I think Lagarde is quite happy with what she has put in place. They have a policy review as well, and who knows what that's going to come up with. It's not going to come up with anything in the very short term, I would have thought. But the next several meetings of the ECB are going to be interesting to see if they hint at some change. That would support the dollar. But I think in the meantime, the dollar basically is, the danger in the dollar is down, and the danger in the Dixie is down. The fact that it closed below this box between 92.62 and 93.14 indicate, and right on top of this, sort of trend line which goes back decades, indicates that market participants are going to take every opportunity to, make 0.5% of the downside. I think the trend, both for the weeklies and for the dailies, is now very much set. I would be surprised if we saw the dollar above 95 in any of the next this year. Okay, so I think that all the dangers are going to be on the downside from good levels. Is this a good level? Not particularly so, but I think they will continue to push it until they find support. Where are they going to find support? They're going to find support here in the high 88s. That is going to be the first real level of support, or here around 91. 91 is, previous low and previous highs. So that is going to be and I'm going to put here we go, 91 is going to be the first support, and the real support is around the 88.50, 88.70 area. I think they will try and push it. I think that is going to match up very well with the target in the Euro USD around 124, 125. And I think at those levels, those are the levels that Lagarde is going to be very much uncomfortable with the euro exceeding, and where she comes in and does something similar to what the Fed has now done. And that is really going to put even more pressure on risk to go up, because it's going to be a race to who can hold the bond market stable at the lowest possible imaginable levels. In which case, the dollar stops going down and starts probably going up, retracing 0.382, zero point 0.5 of the move. And that is even more stability, and so we are going to have a race for which stock market goes up most. Is it going to be DAX? Is it going to be EEM? Is it going to be the SPX? And I think we're going to get that race now in cycles. Who can pressure the bond yields and keep them down for longest and at the lowest possible level? At the moment, the Fed has taken on that baton. Good, let's press the dollar down towards this 91 level, see a small bounce back down to 88, and then force everyone else to do something, and then get it back up towards the 95. I think really the path of least resistance, every time the dollar rallies technically 1%, people are going to come in and smack it back down. I think this weekly chart of Euro USD is very telling. First close of the week above 118.40 odd, which held very well despite the spikes above it, and Bollinger Bands expanding. I think our target is here 124.53, which matches up, which I've just shown you in the Dixie. I think that's the path of least resistance. I think up here, Lagarde becomes very uncomfortable and comes in and does something herself, which pushes up German and European risk. So, at the moment, it's a question of the US dollar going down and therefore US risk being favored over European risk, and it'll get reversed somewhere around that 124, 125 area. I think it's really as simple as that. I'm buying some 118.50, 124, 1x2s for 2 months, a month, 2 months. Why not? It doesn't seem like you can lose too much money. Well, thinking about it logically, if bond yields are going to stay compressed and suppressed for a very, very long time, and if the US dollar is going to be on its back foot as a result, well, what is going to do well apart from risk and multiples? Precious metals will not be suppressed, will they? They have a higher probability of going up than going down. I think next week we're looking for gold around the 2020, 2030 area. I still believe that it's too early to see a huge breakout and close at new highs and a continuation, because we don't have the reality of inflation. We're nowhere near that reality. Basically, what we are just doing in precious metals is compensating for low yields and the fact that low real yields and the fact that the US dollar is slowly going down. But it doesn't have that much to go down. The differential is not going to be that huge. So could we see another 5% in gold? Yes, we could, but probably more so in different other materials, real metals, because now you are saying we are saying is that we're going to have rates so low for such a long period of time until the economy absolutely booms, and a booming economy implies industrial metals are bid, right? So precious metals and metals in general should find a decent bid. Copper should be bid. Gold should be bid, silver should be bid, and in fact the differential between silver and gold seems to be going out, so probably silver is a better buy than gold. I find this chart of silver over gold quite fascinating, and really what are we aiming for that spread, why do I think silver is actually now probably a better buy than gold? I think we're looking for this 0.1486 ratio level. That's a decent move. Another 4 or 5% outperformance. Let's see it. I really can't see industrial metals not continuing to be bid at this stage. It's unlikely that commodities are going to be strong underperformance in this kind of environment. I wanted to also show this chart of DBC, which is commodities. I think it's now unlikely, given this macro scenario, that we don't revisit where we were at the beginning of 2020 at some stage, say by the late fourth quarter, which is around the 15.5 to 16, and we're still at 13.50. That's a double-digit move. Everything points towards multiple expansion in equities, and therefore everything points to the market discounting higher commodity prices that the central banks want to achieve in order to run the economy hot. I just don't see that the next big move in DBC can be down. I don't see that the next big move in gold can be down. I don't see the next big move in copper being down. I think everything is more likely to rally than to go down. Okay, thinking about it logically, what should happen now with EEM? Well, logically, I am completely wrong. I bought some 45 to 42 put spreads. I think now it should really start powering up towards 52. It makes sense because if the dollar is low, normally the lower dollar period has equated with a 15 to 20% move higher in EEM. A lower dollar eases their funding problems and repayment problems, but also the permanently lower for longer yields help them with their multiples because EEM has the lowest multiples. Therefore, multiple expansion there can go a long way. Multiple expansion from 23 to 25 in the US is one thing, but multiple expansion from 12 to 17, 18 is has got much greater potential in EEM. EEM could now potentially really start screaming higher. I think it was ready to do that here at in late 2020 before coronavirus just smacked it. I now am reverting to buying the calls. I didn't lose any money, fortunately, because I was long SPY against it, but I think now EEM is really likely to take up the mantle. I would be very surprised if we don't see the 50 level over the course of the next couple of months. What to say about SPX that I haven't said 1,000 times? It's risk on. I mean, it's simple as that. It'll just keep on going until it becomes unsustainable. But I don't think it becomes unsustainable until 4,000 or very, very close to 4,000. We still have another good 300, 400, 500 points to go up from here by year end, simply because multiples will be pushed to something around times 25 unless there is an accident in the bonds. And I don't see there being an accident in the bonds for a long time. I think the Fed will succeed in keeping the yield curve where they want it. I can't imagine that the market will get its way the first time round. It's going to take months for the bond market to have enough confidence and strength to fight the Fed. I really don't think that is going to happen tomorrow. And given that, I don't think that the 530s or the 510s are going to break the levels that I showed you earlier, and therefore I don't think that the market, the SPX, can find the strength to break this 33.93 previous high to 33.37 kind of level that is so important. To me, that is a swing. It ever closes below there, I'm out, because I don't understand what the hell's going on. But I don't think it will. I think, it's going to be supported, and slowly go up along that red line in deviations until at some stage towards year end, beginning of next year, we are discounting basically 25 times 160 earnings in 2021, late 2021, beginning of 2022, and that would possibly even be pushed out to $170. So, 4,000 is my target, and I see absolutely no reason to deviate from it. Give 5% either way, who cares? But towards 4,000 we're going. Okay, so this is what I said last week for your convenience, so you can stop the video and have a look at it. And this is what I'm saying basically this week. It's not that much different, but it is slightly different. 2s10s, I can't see the 2s10s moving. Okay, the 2s10s I think are now pretty much giving a few ticks. That should actually have said around the 75 level, but I mean it's going to be 40.75 as opposed to what it was previously, but I don't see that much changing here. 530s is where the action is, and I think this 140 level is going to be very, very important on the downside, and 105 is going to be massive on the upside. If it starts going through 105 at some which I don't expect for weeks and weeks and weeks, then we have something going on which is quite troubling. But I think that we are going to be now contained by this 140 level. If we start going through 140, there is some trouble with risk. Okay, the steeper yield curve, the risk will not like it. But I think as long as we stay within 140, that is fine. I think the Dixie now, the move is going to, the natural move until Lagarde comes up, and unless Lagarde comes up with something different, is going to be a move towards 88.75. 91 for support and then 88.75. That is what I see. I think this area now is unlikely to be seen, and if it's seen, it's going to be a massive, massive opportunity. But, Euro USD, as I showed you, that 124 odd is the target now. Gold, it's precious metals now have one direction for impulsive move, and that is up, and another direction for consolidation moves, and that is down. I think the 2020 level on the weekly chart is where the Bollinger Resistance is. I think that is much more likely to be seen than the 1860s very, very strong support. I think every week now the natural move is going to take it higher from dips and make the money that way in gold and in commodities, as I showed you. Here we are, SPX and NQ. I think it's just going to crawl up along the weekly Bollingers. These are the crucial supports, but I just don't see them anywhere near tested. There is no reason, unless the bond market starts doing something stupid, and I don't think the bond market is in a position to start doing something stupid with the Fed saying what they are. I don't, the Fed, the bond market is at some stage going to test the Fed, that's for sure, but it's not going to be for a very, very long time. And finally, I just added EEM because I think now that close above 45, which becomes a swing level, gives you an opportunity to see the mid 50s, and that's a big move. I think what it's going to do is going to crawl up along the red line in deviations, which next week comes in around 46.50. Download deviations and have a look at it. And here I've written down that Fed note. I think it's not brilliantly written, but it contains all the elements that you need to understand what is going on and why multiple expansion has really no alternative at the moment. It's just a question of which market will expand multiples next. It's basically a series of catch-up moves, and I think that EEM now has the best possibility compared to SPX or even NQ. Thank you very much indeed, and tweet you on Monday.